Welcome to Cover Your Assets. I am attorney David Meyer. My radio show shines light on a growing problem in our country, investment fraud, and its impact on Main Street individual investors. We are the voice of the individual investor here at Cover Your Assets. Today we're going to focus on the retirement savings of public employees. The millions of public employees in this country who are entrusting their financial future on state public pension funds. If you are a public employee who is contributing your hard-earned dollars from your paycheck to a public pension managed by a state, you will be interested in what we are going to talk about here. And if you live in Ohio and pay into a public pension fund, you definitely want to listen to our show today. I think you will be shocked at what you're going to learn. Again, I am attorney David Meyer, the investment fraud attorneys at the law firm of Meyer Wilson. We're a group of lawyers who spend all day, every day, chasing down stockbrokers and financial advisors across the country who lie, cheat, and steal from their clients. The purpose of our firm is twofold. We educate and we advocate. We educate by speaking to civic groups, Rotaries, lawyers, accountants, retirement homes, investor groups, and we educate them on, when we talk to groups, we talk about how to avoid becoming victims of investment fraud, what to look out for before you entrust your life savings with a financial planner, and if something does happen, what can you do to recover your losses caused by investment misconduct. We also advocate, we fight, we represent investors all across the country who are victims of investment fraud. Our firm has recovered over $350 million on behalf of our clients over the past 20 years. There's only one thing to do with a crooked stockbroker. We straighten them out, and that's what we do with the law firm of Meyer Wilson. If you cannot catch the entire radio show today, we do put this show up on our law firm's website every Monday morning. Our website is investorclaims.com, www.investorclaims.com. Meyer Wilson has offices throughout the country in Ohio, Michigan, and California. We've been fortunate over the years to represent many individuals in the state of Ohio. And I want to focus today on an issue that's impacting state employee pensions across the country, but the damage is significant, in my opinion, in the state of Ohio. Last week we talked about the movie The Big Short, how Wall Street hedge funds profited off the backs of Main Street Americans during the Great Recession. We talked about the trillions of dollars of retirement savings that was lost during the Great Recession. But oftentimes when we talk about retirement savings, we talk about employees who work in the private sector with 401ks and IRAs. But there's another group of workers who were particularly impacted by the Great Recession. Folks employed in the public sector, those who rely on public pension systems in their individual states. Public employee pension funds are, in Ohio, it's a big business. Public employee pension funds provide retirement benefits for nearly 2 million people in the state of Ohio. There are three of the largest pension funds in the state of Ohio include, number one, the Ohio Public Employees Retirement System. That's for public workers. It's known as PERS, P-E-R-S. And there are roughly 1 million retirees and members of the Ohio Public Employees Retirement System. The second largest state pension fund in the state of Ohio is STRS. That's the State Teachers Retirement System. STRS covers nearly 500,000 teachers and retirees in Ohio. The third largest state pension fund in Ohio is SERS. That's the School Employees Retirement System. That's bus drivers, cafeteria workers, janitors, secretaries, the folks in the education system who are not teachers. That's SERS, and that covers roughly 300,000 janitors, bus drivers, cafeteria workers, and retirees. But I want to talk about the Ohio Public Employees Retirement System, OPERS. There are 1 million active members and retirees, as I mentioned. It's the largest public pension fund in the state of Ohio. It affects about 1 out of every 12 Ohioans. I think it's important to note that in the state of Ohio and other states as well, state and local government workers in the state of Ohio do not participate in Social Security. So many of Ohio's public workers rely on their pension for a dignified retirement. They don't have the benefit of Social Security. So the public pension fund is their sole source of retirement for many folks. In the Great Recession in 2009, PRS lost about 20 to 25% of its total value. So in the height of the Great Recession, think about the total value of PRS, the Public Employees Retirement System, the largest pension fund in the state of Ohio, lost 20 to 25% of its value. And as a result, in order to make up for those drastic investment losses, the fund made dramatic changes to benefits. And if you are a participant or a member of OPRS, you know that you had significant changes in benefits. And there were also other benefits to STRS and SERS. And those changes were made in large part to address the massive investment losses suffered in the Great Recession. Okay, so what's happened since then? We go from 2010 to the present, so we're more than 7 years into one of the greatest bull markets in the history of the stock market. The stock market is up nearly 300% since the end of 2009. So before the Great Recession in 2007, PRS was nearly 100% funded. They were in great shape in 2007. So we go through the Great Recession, they lose 20 to 25% of their value, and then we see over the last 7 or 8 years a 300% increase in the stock market. So the question becomes, has PRS recovered to its pre-recession status in terms of the value? Are they back to where they were? Are they nearly 100% funded as they were in 07? And you think that they should be, given the dramatic rise in the stock market. But the answer to that is absolutely zero. In fact, in 2015, OPRS paid out almost $4 billion more than it took in. The investment returns in 2015, as one example, were pretty much even. They made, I think, $10 million total. That's far short than the $7 billion increase in value it's called for in their 8% return on investment assumption. It is set up to return, it's assumed to return 8% a year. In 2015, it returned zero. And as a result of the current status of the value of PRS, the OPRS is considering cutting the cost of living allowances for its 1 million retirees. They're considering cutting the cost of living increase. And in fact, given the current status of PRS, we're going to dive into why, try to answer the question, why has PRS not recovered given the 300% increase in the stock market since the end of the Great Recession? And right now, according to reports, there is only a 50% chance that PRS will even have enough to pay its retirees in 20 years. So what's the reason for this crisis? Is it higher drug prices, the higher medical costs, people living longer? Is it that? Is that really the reason? Let me tell you why I think a big part of the reason that PRS has not recovered since the Great Recession, despite the large increase in the stock market. Since 2010, hedge funds have aggressively pursued U.S. public pension dollars. Hedge funds, and we talked about this in last week's radio broadcast, are private investment funds that are available only to sophisticated institutional investor and individuals who have significant assets. They are very lightly regulated, and they invest in alternative investments, opaque investments that are complicated, sophisticated. They're often difficult to value. They're not very liquid. They're not things that can be sold on the market like typical stocks and bonds. From 2011 to 2015, so 4 or 5 years, again, this is in the heart of the bull market. OPRS, the hedge fund investments in OPRS went from essentially zero all the way up to $12 billion. In 2010, OPRS had 0 hedge funds in their portfolio and paid external managers about $128 million to manage their portfolio. Compare that to 2015. So again, in 2010, they had no hedge funds, and they paid $128 million. And they had about $85 billion in assets. In 2015, they paid nearly $430 million to outside managers. How about that? That is an unbelievable amount of money paid to hedge fund managers. And in fact, as of 2015 or 2016, PRS is the most active hedge fund investor in North America. That's according to a publication called Institutional Investor. In addition to being the most active hedge fund manager in the country, they're in the top 5 most active hedge fund investor in the entire world. So if you are a public worker and you have your money, your deferred wages, invested and entrusted with the state's largest pension fund, PRS, your deferred wages are funneled directly to Wall Street to their hedge fund managers in an unbelievable, staggering amount of money. I mentioned in 2015 that the return for PRS was essentially zero. I think they made $10 million. Again, they've got something like $80 billion in assets. But they paid more than $400 million in fees. So why are the results so bad? Well, let's talk about how much hedge funds they held. In 2015, PRS had nearly 13% of its $86 billion in hedge funds. 13% of their entire portfolio was invested in hedge funds. In 2010, zero. So 5 years later, they've got nearly 13%. That is a tremendous concentration, in my opinion, in hedge funds. So, how are the results? They were horrible. During that 5-year period, the S&P returned something like 13% a year, annualized. So for a fraction of the expense, the PRS would have returned multiples in investment return. Let's look at 2016. The fund ended 2016 with its highest underfunding in its history. So it's as underfunded as it's been in an extremely long time, and that's despite a nearly 300% surge in the S&P from the lows of 2009. These hedge fund managers are billionaires, many of them who manage the deferred wages of hardworking Ohioans and Americans throughout the country. These folks are making billions of dollars. I read yesterday, in fact, in reading for the show today, that the top hedge fund manager last year brought home almost $1.5 billion. Can you imagine? $1.5 billion. I also read a statistic that the top 25 hedge fund managers, in 1 year, their income, the income of the top 25 hedge fund managers in 1 year was more than the collective income of every kindergarten teacher in the country. It's unbelievable. And so hedge funds charge what's called the 2 and 20. They charge 2% of what they invest and what they manage, and then they make 20% of any profit. So they're making 2% regardless. So regardless of how they perform with the public employees' money in PRS, they're making 2% a year. And there's also the thing about hedge funds that it's mind-boggling to me that Ohio pension funds would invest so much of the money is that the fees aren't clear. It's nearly impossible to identify all the fees charged because they're often not disclosed, and it's virtually impossible to determine what the actual fees are. So the fees that we can recognize and the numbers I talked about are the fees that we can ascertain. But there's always more fees, and because hedge funds are so lightly regulated, it's extremely difficult to understand what's really costing the public employees. We're going to take a break. I'm attorney David Meyer. You're listening to Cover Your Assets. We'll be right back. Thank you.
flowing real well.
Alrighty. All right. We'll get started here. All right, welcome back. It's attorney David Meyer with Cover Your Assets. We're talking about how hedge funds are ripping off public employees. We're focusing on Ohio because Ohio's largest pension fund, PRS, has about 13% of its entire $85 billion in assets invested in hedge funds over the last few years. That's an unbelievable concentration. And the performance has been abysmal, and the fees have been astronomical. So what can you do about it? Well, and what damage is it causing? Well, I mentioned earlier in the show that PRS is already proposing to do away with the cost of living increase. Now, they explain that it's because of rising health care and that members are living longer. But what about the loss in income and appreciation from the fact that they've been investing in these hedge funds, which without a doubt has performed just horribly over the last 5 years. I mean, there's no dispute about that. The performance has been horrible year after year, 2010 all the way up to now. And especially compared with the stock market in general. Had they just had a well-balanced portfolio invested between the market, between equities and bonds, they would have seen a multiple, 150, 200% increase. Just the S&P alone, all equities would have demonstrated a 300%. We would have been right back to where we were in 2007 with nearly 100% funding. So they've paid out hundreds of millions of dollars in fees that we know about, plus who knows how many fees that haven't been disclosed and aren't really known. We've seen horrible results. The PRS is underfunded now dramatically, facing cuts to benefits. What can be done about it? Well, I tell you, and I'm an investment fraud lawyer, so I represent investors who have claims against brokerage firms and financial advisors and insurance companies for investment misconduct. And if somebody were to call me and said that their employer, somebody who is a 401k participant in a large employer, and they told me that their employer was using discretion and investing 13% of the company's retirement plan in hedge funds, and that they were paying absorbent fees and only recovering and woefully underperforming any kind of well-balanced portfolio, they would have a claim. Absolutely. Absolutely. Let me use one more number for you that I think is just stunning. If you look at 2006 to 2014, the performance of PRS, when compared to the net returns from 2006 to 2014, PRS paid 54 cents for every dollar returned to the pension fund versus 4 cents for every dollar net return for the whole portfolio. So they're paying 54 cents for every dollar with respect to pension funds and incorporating the hedge funds, as opposed to 4 cents for every other dollar. So they're paying an extremely high cost to invest in these hedge funds and getting horrible returns. So in a 401k environment with a private employer, the trustee has a fiduciary duty to seek out the highest return for the lowest possible cost with a appropriate amount of risk. That's what the fiduciary has an obligation to do. And if an employee at a big firm came to me and said, look at our performance over the past 6 or 7 years, and when compared to a reasonably allocated portfolio of equities and bonds, if it woefully underperformed it and the cost was astronomical, that is likely a breach of fiduciary duty. If an investment advisor or a stockbroker recommends and implements a portfolio for an individual investor that woefully outperforms what a well-managed portfolio would have done, and the cost is multiples of what it should have been, that could be a claim as well. So if it's a problem and something that is pursuable in a FINRA arbitration or a lawsuit for a private investor, on behalf against a brokerage firm or on behalf of a participant in a private 401k, is that something that should be considered with respect to pension funds who underperform the market at a cost that is multiples of what it otherwise should be? Those are the questions I think people are going to be asking, because the damage is real. This impacts millions of people. And this isn't just in Ohio. Hedge funds made an aggressive push beginning in 2010 to attract institutional investors' pension fund money. A lot of it had, if you compare, and without getting political, because this is both Republican and Democrats, the political contributions from hedge fund and Wall Street since 2010 has been dramatically increased. And it also, is it a coincidence or not, that it coincides with the dramatic increase in hedge fund investments by public pensions. I don't know if it's a coincidence or not, but I tell you, it is impacting individual investors all across the country who rely on the public pensions. Because again, in Ohio specifically, those folks who participate in the public pension, STRS, SERS, PERS, they do not, for the most part, participate in Social Security. So they're relying on the trustees and the board of the public pension. They're entrusting their deferred wages. They're entrusting that those folks adhere to their fiduciary duties because they're relying on this money for their retirement. So I think these are questions that ought to be talked about, and it's complicated because we're talking about a lot of money and it's hard to dig in, but these results are really unbelievable. So that's a nutshell what's going on here with pension funds. And you can, in your particular state, you can dig in and see a little bit about the returns and the expenses. We have a couple minutes left. I always like to end the show with just some tips on what to do for individual investors before you hire a broker or registered investment advisor. All the calls we get for folks who had suffered losses as a result of investment misconduct, oftentimes for those callers, if they would have done a little bit additional due diligence before calling, maybe they wouldn't have been victims of this investment misconduct. But people don't always know what to do before investing with a stockbroker. So a couple tips. Before you hire an investment advisor, be sure to look them up. Go to brokercheck.org, and you can do a background check online. You can do it from your house. You can do it with your pajamas on. You get the name of the broker that you're considering hiring. Go to brokercheck.org, type in their name and their firm, and that'll give you their employment history. It'll provide some information on where they're licensed. It'll disclose if they've had any customer complaints, any regulatory complaints. It's a great first step, and you can do it online. It's not 100% accurate because sometimes folks in the industry can get the items expunged, but it's a great first step. You should never ever invest your hard-earned savings with anyone who is not licensed. We hear day after day victims of Ponzi schemes who entrust their money with folks who are not licensed. Oftentimes Ponzi schemes are run by individuals who claim to be operating under exemption from the SEC that, according to them, allows them to invest money without being licensed. That exemption is very, very narrow, and you should not ever invest money with anyone who is not licensed. And make sure that the security or investment that you're buying is registered either with the state or with the SEC. And never, please, never invest money with anyone who calls you on the phone. There are folks all over the country who sit in boiler rooms even today and smile and dial and try to get folks, particularly elderly folks, to invest with them without ever meeting them. There are plenty of reputable investment advisors and stockbrokers who are in your area, who have offices that you could go and you can talk to. And also, final tip before we end this episode of Cover Your Assets, make sure if you're going to hire somebody to invest your money, make sure they are affiliated with a large brokerage firm. Because in the event something happens, we want to make sure that if you have to pursue a claim and you hire an experienced securities fraud lawyer, that lawyer wants to know that there is a firm behind the individual. So if you hire John Doe who isn't affiliated with a brokerage firm and they run away, then if they're not affiliated with a large brokerage firm or a large financial institution, there's often no place for lawyers like me to pursue the claim. We want to make sure there's an entity there, a brokerage firm there, that can be held responsible in the event there is a situation of investment fraud that is proven. So that's it. Thank you very much for listening to this episode of Cover Your Assets. I am attorney David Meyer with the law firm of Meyer Wilson. Thank you for listening, and we'll see you next time.